volatility is not risk. You can have identical real estate assets, one that's listed on the market and one that sits in a superannuation portfolio, and clearly the exact same set of assets will have different volatility measures.
You've written that private markets aren't superior to their listed counterparts and that it is an illusion created by how they're valued. It's a pretty bold statement given, I guess, where the industry momentum is at the moment. Let's start high level. Walk us through why you believe this is the case.
The question's got to be asked at a macro level. Do we think that 1/12 of our economy can sustain borrowing costs of 10, 11, 12, and in some cases 15 and 20%?
Three of the four big banks have lost their competitive advantage. Private markets are an illusion. Today's guest is certainly not pulling his punches. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryce, and with my co-host Ren, today we're speaking to Tim Carleton, founder and CIO of Auscap Asset Management. Ren, good to be with you.
Bryce, good to be with you. Excited for this one. Always love speaking to Tim. He's a deep thinker when it comes to investment management, and this conversation was no different. From challenging some of our preconceived notions around risk-adjusted returns and how we think about volatility, to questioning the competitive advantages of some of the big four banks.
Ripping on private markets.
Giving us, I was going to say giving us a different framework to think about private markets and the opportunities there. This interview was filled with really fascinating insights. You can always tell a good interview on here for us here at Basis Points and Equity Mates by the amount of comments we leave on the side of our prep doc.
Yes.
And this one is littered with it.
Yes, always great to speak with Tim. Before we get into it, a huge thank you goes to our launch partners here at Basis Points, Orbis Investment, Milford and SIBO. Without their ongoing support, we wouldn't be able to keep all of our content here at Basis Points free. So a huge thank you goes to our partners.
And a reminder for all advisors watching or listening, all episodes of Basis Points are accredited by the FAAA for CPD points. If you want to claim yours, follow the link in the YouTube description or the podcast show notes. Complete the quiz and we'll send you your certificate.
All right, without further ado, let's jump into our interview with Tim Carleton. Tim, welcome to Basis Points.
Thanks very much. Great to be here.
So for those new to the show and hearing you for the first time, how would you describe your investment philosophy?
Yeah, the philosophy that we espouse is pretty straightforward. So we simplify it to quality first, value focused. So all that means is we're looking to invest in the best businesses, but we're mindful of price. Now, there's a little nuance to that equation. There's a reason for investing in the best businesses, and that's because they tend to demonstrate the best earnings growth over time. So we're looking for businesses that have high return on invested capital. A lot of people often know that they should look for businesses that have high return on capital metrics. They're not sure why. Put really simply, if you have two businesses, one that earns a 25% return on capital and one in the same industry that earns a 10% return on capital, there must be something about the first business that enables it to earn vastly superior return on capital metrics every time they invest another $1 million into the business than its peer or than its peer group. And so from our perspective, our job is to then work out from that identifier what that competitive advantage is, whether it's sustainable, whether it's growing or shrinking. And to the extent that it's sustainable and growing, they're the sort of businesses that we want to invest in, because every time they invest some of their profits back into the business, that's going to result in much faster earnings growth than a lot of their peers. And it comes back to a really simple core belief that we have, that over time, your total return on an individual stock or on a portfolio, the longer you stretch time, the more your total return is going to be a function of just two things. The first is the dividend yield that it pays you over time, and the second is the earnings growth that's delivered by that company. Right, so all of the other things drop away. If you take a 10-year time horizon, the change in multiples, what's happening in geopolitics, what's happening in interest rates, all of that sort of stuff fades into insignificance, and the two factors that determine long-term returns, dividend yield plus earnings growth. So we're looking for businesses that are the best in their cohort, because we think that that will deliver them stronger earnings growth over time than their peer group. And as long as we don't overpay for those businesses, then we think the total return equation should look after itself for our investors.
Love that.
Love it. You make it sound so simple.
So easy.
Well, I think a lot of people complicate investing in equities.
Yeah.
So there's a few things that we want to cover off in this conversation. We're getting towards the end of the year, so we want to sort of cover off your views on the year that was, talk about private markets and your view on some of that space, and then dig into your portfolio and a couple of positions.
Sure.
But let's start with the year. And as we were preparing for this interview, we sort of looked back over the year, and you, whether through luck or through skill, you've timed the year pretty well. You were before the tariff-induced volatility earlier in the year, before Liberation Day, you were reducing exposure and building cash. So if we can start there and you take us back to that time of year, what were you seeing and what were sort of the factors that were driving that decision, and then sort of talk us through the year that played out from there?
We certainly weren't trying to time markets. So what often happens when markets become a little bit euphoric is valuations become somewhat stretched. And so as they become stretched, we look at things objectively and in absolute terms. We were reducing our exposure through the end of last year and then early into this year. People obviously getting very excited about what Trump would mean for markets, etc. All we saw was valuations that were becoming extended. So we were reducing selectively in areas. And then obviously as January started to progress, and there were early signs that Trump wanted to implement some tariffs, we could see that you might get a change in sentiment. By that stage, we'd already reduced our overall exposure quite significantly, and we just decided that there was no reason to be in a hurry to redeploy capital. So we ended up with a little more than 10% in cash in the two funds that we manage, which is a little unusual for us, actually, if you go back historically. It's unusual for us to have that much cash. But we could see that things were bubbling beneath the surface and the tone of the market was gradually changing. And we really didn't do much from a deployment perspective until two things happened. The first was we saw the first sign of absolute panic, I think early in April. And at the same time, a lot of stocks that we thought had been expensive, and many of them were long-term holdings in the portfolio, had suddenly looked a whole lot more attractively priced. So when we see both of those things, we are very keen to deploy. In fact, I think on the morning of the 7th, I think, of April, we probably deployed 6 or 7% of the capital for both funds in the first couple of hours, because that was the first time that we saw genuine panic. But we also saw a whole lot of prices that we were very, very happy to pay, largely for businesses that we knew were going to be completely unaffected by tariffs. So that was the opportunity. It was a little bit fortuitous. We certainly weren't trying to time anything to the nth degree. And now we're sort of back to the same situation where in recent months we've been trimming some of the exposures that have done very well because the valuations are starting to look pretty full.
Yeah, well, I mean, we're hitting all-time highs after all-time highs at the moment. So you, I guess you're going to get back to that 10% position, or is it not as stretched as it was end of last year?
It's an interesting market. So we're at about 5 to 6% cash at the moment. The unusual thing about this year, there have been stocks that have done really well, have had all the momentum. Valuations are becoming very stretched. So in particular, in the financial space and the consumer discretionary space, everyone's jumped on board that train as the market started to factor in lower interest rates. Anytime people are jumping into positions for some macroeconomic factor, we start to become a little bit cautious. So we've been taking money off the table in those areas. On the other side of the coin, unloved sectors have remained unloved. In fact, many of them have started to drift even lower than they were at the start of the year. So interestingly, just as we become slightly more concerned around valuation and the assumptions that are underpinning people buying into the more cyclical parts of the market, the defensive parts of the market are actually looking quite attractive. So if we think about a few sectors, some of the real estate trusts to us look pretty compelling from a low-risk total return perspective. Healthcare is probably the most attractively priced it's looked in absolute or relative terms for probably the last decade. So
Nice.
It's slightly different to the start of the year in that we can see other pockets of opportunity where we are happy to deploy, and that's what we've been doing. So we hold a little bit of cash, but the very nature of holding a large defensive portfolio means if the whole market does get whacked, hopefully the defensive parts of your portfolio hold up better. And if there's suddenly really compelling opportunities in other sectors, you can take the money out of those defensive sectors and redeploy into great opportunities elsewhere.
Yeah.
When you're talking about valuations being stretched, how much are you looking at a sort of top-down overall market level? Like we're seeing more and more conversation about 2025 looking like 2000 and some of those like overall market metrics, or how much is it just purely based on the individual holdings in the portfolio?
It's mostly on the individual holdings. I mean, we're aware of how the market is priced from an overall perspective, and it's a little bit above its long-term cyclically adjusted price to earnings multiple, but it's really at the stock level. I mean, some great companies that we hold have had pretty amazing re-rates, and so we've been taking money off the table. I mean, we think Eagers is one of the best-run companies in the market. Now, wind back a year, it was trading near $10, and today it's in the 30s. The earnings have gone up, and they've gone up materially in that time, but nowhere in that order of magnitude. So what constituted one of our largest positions, a year or so ago is certainly not the case today. So we've just been trimming at the edges where we think valuations have potentially got a little ahead of themselves in the short term.
Now, Tim, we want to turn to private markets, a part of the, investing ecosystem that a lot of advisors and fundies on this show particularly have come in and spoken about how they're now taking a larger portion of, position sizing in portfolios and the like. You, on the other hand, you've written that private markets aren't superior to their listed counterparts and that it is an illusion created by how they're valued.
This is the danger of writing things that can be quoted back
we
to you.
appreciate it researching because you've written a lot. So there was a lot of information on all of this. It's a pretty bold statement given, where the industry momentum is at the moment. So just let's start high level. Walk us through why you believe this is the case.
Okay, well, if we start from the beginning, the starting point for any comparison of assets is the return that gets delivered from that asset, right? Now, it didn't take long for someone to come along and say, well, that's not fair. You shouldn't compare an equity return to a government bond return. If they both deliver 6%, surely the 6% delivered by a government bond was much lower risk than the 6% delivered by the equity market. And that was self-explanatory, and so people started to think about risk-adjusted returns. But of course, we can't measure risk, and so we needed a proxy for risk. And the proxy that has been settled upon is volatility, right? Volatility of returns or volatility of price, right? But of course, volatility is not risk. And to make that really simple case, you can have identical real estate assets, right? One that's listed on the market and one that sits in a superannuation portfolio and gets marked at director vals or external vals every 6 or 12 months. And clearly the exact same set of assets will have different volatility measures. One's in the public domain where it's traded actively from 10 o'clock to 4:10 every business day of the year by a whole group of investors with varying degrees of knowledge and sophistication. And the other is marked by professionals once every 3 to 6 months or occasionally every year, right? So if two groups of identical assets can have very different volatility characteristics, then clearly volatility is not risk. But of course, once that assumption was made, off that was spawned a whole bunch of different ratios and metrics that people analyse because they think it gives them a fuller picture of a particular investment. So we've got Sharpe ratios and Sortino ratios and information ratios and tracking errors and everything else all spawned off the price volatility of a particular asset. Well, of course, there's lots of super smart people in finance. And so the smart people in finance realised, well, to get better risk-adjusted returns, we can actually change that equation so that it's in our favour, right? And the first thing you want to do is you want to take it off being marked 1,000 times a day from 10 o'clock to 4:10, right? And so you remove the number of data points because definitionally, if you remove the number of data points, you're going to have less volatility, right? And then the second thing they do is they say, well, let's take away all of the less sophisticated players. Let's not let mums and dads mark that asset. Let's not let fund managers mark that. We're just going to mark it based on an independent external valuation that's done every so often, right? And so all of a sudden, these assets that are in the private sphere with similar or even worse return characteristics to their public equivalents on a risk-adjusted basis, so take the return and divide it by the standard deviation, they suddenly appear a whole lot better, right? And we saw great examples of this through the COVID period. Take the largest, we talked about it already, the largest automotive group in the country is Eagers. They have about a 14% market share. They dwarf the number 2 player, which is down in the low single digits, right? And a number of private equity houses own dealership groups that are, sub 2% in market share. Well, Eagers' stock price during COVID fell 70% peak to trough. And obviously then on the rebound, you get the volatility in both directions because volatility is just price change. And that contrasted with some of the markings that we saw in private equity portfolios for much smaller, much less sophisticated, much less capitalized businesses that were sort of orders of magnitude smaller. I'm talking 5 to 10% from peak to trough at the director vals, right? Now, clearly Eagers is not an inferior business. It's not a riskier business than those other businesses. But that's the problem when you take a concept in finance and then manipulate it in a way that produces superior outcomes for the purpose that you're trying to achieve, which is let's move more capital out of the public market and into the private market, ignoring obviously all of the detrimental side effects of doing that. And the most obvious of those being, a lack of liquidity, which we're starting to see in private markets now.
I love that.
Yeah.
So that's one side of the equation, the risk-adjusted part of the term. The returns is the other part, and we also dug up something else you wrote. So I'll quote it back to you.
Is this concerning?
Yeah. Quote, we would be astonished to find a private capital vehicle that owns a better selection of businesses than the companies in the 2 funds that we manage.
Love that.
So let's get to the return side of the story, because I guess that's where a lot of the conversation is and a lot of the debate is. And it's like, is the opportunity set better in public markets or in private markets, with companies staying private for longer and deeper pools of capital in private markets than there were historically?
Yes.
So how do you think about the return side of the equation and the opportunity sets in public versus private?
Sure. Well, if we think about an Australian context, because that was the reference point, Australian companies. If you look through our portfolio, and we publish the top 20 holdings in both portfolios, which make up the vast bulk of our portfolio, typically 80 to 85% of the high conviction fund is in the top 20 investments. So when we publish that every month, you're seeing the bulk of the portfolio. And what you'll notice there is that we own the category leader. So I'm not saying that there isn't the odd business that's a market leader in one particular sector or subsector. I'm saying from a portfolio perspective, it's not true that there are better operators than the largest listed retailers or the largest listed auto players or financial services company or insurance brokers and so on and so forth. The categories are quite lengthy. And so when we made that comment, it was simply a reflection of the fact that the largest, most efficient, highest return on capital businesses in a lot of the sectors in the Australian market are available to you on the public market. And quite often what we see in a lot of private portfolios is actually the 3rd, 4th or 5th player, or maybe even lower down than that we know is an inferior business from a return on capital perspective than its listed peers. But of course, once you're in the private space, you can do things to enhance the returns, and the most obvious way to do that is through leverage. Right? If leverage isn't affecting the volatility of the company, if you lever up a listed company, then what happens is its share price moves around absurdly, because when you're at a cyclical trough, all of a sudden everyone focuses on the leverage and sends the share price plummeting. Well, obviously that doesn't happen. So unless your banks are calling in their loans in the private space, you never see the additional risk or the additional volatility, if you like, that would come to the earnings of that company from having a lot of leverage, and yet you obviously juice up the equity return. So the point we've been making is that the rush to private markets just needs to be considered and thought through, because we're certainly not convinced that there's a whole range of superior assets that are just demanding your attention on the private side.
Well, just I guess noting like where we are in the cycle, we're seeing more and more super funds allocate to it. We're seeing more and more sort of private advisors or high net worth advisors allocate to private. Are there any concerns you have about where we are in just like the overall cycle that is for advisors listening perhaps to help them think through it?
Well, I guess what I'd say to that is APRA have estimated, I think it was APRA, have estimated that there's a little over 200 billion of private credit outstanding at the moment. Now, those borrowers are paying typically 10, 11, 12% plus per annum. So if you think about that 200 billion in the context of an Australian economy where GDP, which includes all of our exports, is running at 2.4 trillion, the question's got to be asked at a macro level, do we think that 1/12 of our economy can sustain borrowing costs of 10, 11, 12, and in some cases 15 and 20%?
Yeah.
Right? And my simple answer to that is no. Now, I don't know where the pockets are that might cause problems, but I'm sure there will be because the math just doesn't stack up that I think that there is $200 billion of good credit that can afford double-digit interest rates. I mean, I know the power of compounding, right? And there's an old adage in markets that those that understand it receive it, those that don't pay it, right? So I understand the compound impact of a borrowing cost at those sorts of levels, and it's phenomenal. It will eat away your capital very, very quickly. So, that concerns us. And then obviously the emergence of this sector in such a short time period means that definitionally you'll have a lot of fund managers that aren't experts in working out situations, right? And you don't want to see a situation where a credit lender suddenly becomes an owner of a whole bunch of different operating assets, right? Because the chances are reasonably high that there are a number of these groups that are no different to us. We might be really good at analysis, on level 30 of our skyrise building, but you probably don't want us running a building company or a restaurant company or any other sort of company, right? And so the level of expertise that's required when something goes wrong, and things do go wrong in the credit space, to then work that out and get your capital back, we think is probably possessed by a relatively small number in the domestic community and a much smaller pool than those that are currently lending other people's money in the first place.
Interesting.
So, Tim, we want to turn to your portfolio, and I think we'll start by giving you your flowers because the track record speaks for itself. Since December 2012, the High Conviction Fund has delivered 14.9% per annum versus 9.8% for the index, so outpacing the index by more than 5 percentage points a year. Got to be happy with that.
We are happy. I mean,
that's not the question. That's
the softest form.
That's the easiest question I've ever asked.
I appreciate that.
So now we get to the hard questions. So if you think about the that's over a pretty varied market timing when you think about what's happened since 2012. What do you think's been most important for the outperformance over time? Like, where do you attribute that outperformance to?
I think the number one thing that people should focus on is limit the investments that you participate in to those companies that you're really happy to own for the long term. So from our perspective, the most important factor over time is having a really strong quality filter. And if I was being completely honest, the mistakes that we've made, and we made far more mistakes in the first 5 or 6 years than in the last 5 years, which I'm very happy about, is reducing the number of mistakes that were made because you invested in businesses that you should never have invested in, right? Where you lowered the quality threshold or you thought something was an exception to the rule. You didn't invest in the best player, but you went with the third best player that you knew had issues. I mean, the interesting thing about investing is if you invest in best of breed businesses, the number of times that they surprise you positively is remarkable. And unfortunately, the converse is also true that if you invest in poor businesses, they have this unbelievable way of coming up with negative shocks and surprises that you weren't even thinking about when you invested in that particular business. And so having a really, really strong quality filter is definitely foundational to our returns over time. And then the second thing, I know you only asked me for one, but I'm going to stretch it to two, is keeping it really simple. So we don't try to do anything tricky in the market. We're not interested in stag profits. We're not trying to time this or time that. We want to invest in great businesses for long periods. We want to buy those businesses at prices that we find fair or better than fair. And then we try to spend a lot of time doing a lot of research so that we understand those companies really well. But we don't do a lot of activity with that information, right? Like good investing is about doing a lot of research all the time to then actually do relatively little activity, which is very different from almost any other pursuit you engage in, right? Like if you do go and do a lot of work, you feel like there should be some sort of outcome, right? Well, a lot of the time with investing, it's just to continue to hold your existing portfolio, or maybe you identify a really good business, but you're not happy with the price. You can see headwinds, and it might be 5 years down the track when the research that you've done extensively on a particular business pays off, and you get a really great opportunity to buy into a business. But there's not the automatic I do work, I get result that I think human beings crave, and that's what makes it a difficult endeavor, I think.
I want to follow up on the quality filter that you mentioned there, because I think throughout this conversation, we can draw out some of the things that form part of your quality filter. You mentioned market share and finding the winners in their particular field. You mentioned return on capital. I imagined seeing like operating leverage and seeing earnings growth growing faster than revenue growth is profit growth growing faster than revenue growth is something. But is there anything else that we haven't touched on or that you haven't mentioned so far that you think is really important if people are building a quality filter checklist?
Well, we're really focused long term on companies that can deliver earnings growth well above the broader market. And that will often come from a company having a competitive advantage that they can exploit. Right? If I bring this all the way back to the volatility point that we started on, you can take two companies like JB Hi-Fi and Harvey Norman, right? Volatility will tell you that JB Hi-Fi is the riskier proposition and has been since it listed in 2003, right? Its standard deviation is, I think, 3 percentage points higher than Harvey Norman over that time, right? We would argue that that is entirely misleading, right? It was very apparent from us from very early after they listed that they had a model that was superior to Harvey Norman, and as a result, they were going to take share from Harvey Norman for a long time. And as it stands here today, we think that will still be the case going forward, right? And so what has that meant? Well, they have compounded earnings at just under 20% per annum for 22 years, right? Which is pretty extraordinary. So from a price perspective, you're up 55 times on your initial IPO investment, right? Now, at the same time, Harvey Norman, who often gets a lot of followers because it trades on a lower multiple, it's grown earnings at 3.7% compound, such that today its share price is only a little more than double where it sat 22 years ago, right? So to argue in that environment that JB Hi-Fi was the riskier proposition when it clearly had a competitive advantage, it had the lowest cost of doing business of any electronics company we're aware of globally, despite all of the challenges of operating in a country as big as Australia with a population as small as Australia, right? It has done a phenomenal job, and what differentiates it from its peers is its high return on capital that allowed it to expand and take very, very considerable share. And that's resulted, surprise, surprise, in the price also being up a little bit less than 20% per annum, or 55 times in the same way that its earnings are up 55 times, right? So it's grown earnings from 8.4 cents to $4.68 over that period. Harvey Norman's grown earnings from 14.5 cents to 38 cents or 39 cents, right? And so what you want to focus on is finding businesses that can deliver that earnings growth over time, and then be conscious of the price you're paying, right? Try to get decent value, but it's more important to be on the journey, because the longer you stretch time, the less your purchase price at the start has mattered, and the more your total return has just become a function of those two things. The dividend yield that's been paid, which has been about 5%, and the earnings growth that they've delivered, which has been about 20%. And that's meant that JB Hi-Fi has compounded for shareholders at about 25% per annum since it listed.
Wow. Love that. So, Tim, you've written that patient deployment, when opportunity arises, lays the groundwork for higher prospective returns. So we'd love to now just get into where the opportunities are at the moment. What, like at a sector level, perhaps we start there, and then we'll get into some specific stocks. Where are you actually seeing opportunity and deploying that sort of patient capital?
Yeah, so as I mentioned, real estate is one, particularly retail real estate. We think it's a really underappreciated part of the market. We like parts of the healthcare landscape. You've got to be aware of competitive threats, but there are certainly some businesses in that space that we really like. In fact, even parts of the construction market, particularly businesses that have international operations, where there have been very apparent headwinds for a number of years now, are starting to. We think you're getting a pretty attractive opportunity on a through the cycle basis as we sit here today. So, from a company perspective, in the real estate space, we really like HomeCo Daily Needs REIT and Charter Hall Retail REIT. Retail assets are monopoly assets.
Right.
Once they're in part of the built environment, it's very difficult to replicate the shopping centre. There's just not the space. So once you have the population density, what happens over time, particularly in a country with strong population growth, both organic and inorganic, in other words, our births less deaths are a positive number, but we also have strong net migration, then that results in more and more people going to these centres, which enables you over time to lift rents much faster than other parts of the market. So we think the retail assets that we own are fantastic. They typically have north of 99% occupancy, which is about as good as you can get, because you'll always have some tenants that are switching from one tenant to another. So there's always some downtime. The rents that tenants are paying at the moment are relatively low compared to other parts of the retail complex for those two groups of asset holders. And so we think you're going to get a 7% yield. It's probably going to grow at 4 to 5%. There's additional developments that they can do on their sites because most of them have relatively low coverage that will add incremental value over time. And as I said to someone only a couple of days ago, anytime you can find what you think are relatively low risk, 12 to 14% type total return opportunities, you should take it, because there are very few of those that come along, and we would certainly put some of the retail real estate assets in that camp at the moment. And what's more, they're trading at discounts to net tangible assets. And from the evidence that we're seeing in private markets, actually those net tangible asset backing values are probably light on. They should probably be north of where they are. So the discount to NTA that you're getting at the moment is probably understating the true discount to the NTA if they went and sold all of the assets to a super fund. So that's pretty interesting in real estate. In healthcare, we're quite keen on both ResMed and Sonic, both leaders in their respective fields. They're both trading on absolute and relative valuations that are compelling over time, and they've both faced recent short-term setbacks that have meant that they are not the flavour of the month, and that's typically when we find ourselves accumulating positions. With ResMed, there's obviously been the GLP-1 debate and whether that would hurt their market, and on the Sonic side, pathology's been a pretty difficult space because we haven't had indexation in this country and other parts around the world, and we're just starting to see some changes that they're starting to get indexation for a third of their tests. We expect that number will increase over time, but they're also coming off the huge COVID high where they made a lot of money as a result of the COVID testing, and as a result employed a lot of people, and healthcare companies aren't of the mindset that they go and fire a whole lot of people that they just brought on. Yeah. And so they've got a bloated cost base that's working its way through the system. So we're quite excited by both of those opportunities, and it doesn't surprise us that at the point in time when everyone's chasing cyclical growth that we're suddenly seeing compelling opportunities in some of the defensive parts of the market. Probably the one cyclical area where we actually do have some interest at the moment is in that construction space. So companies like Reece and Reliance, we think we're pretty close to the bottom of the cycle. They've obviously been hit by a few things to the extent that they operate in the US. Almost everyone that owns a home in the US refinanced when rates were close to zero, which means their long-term mortgage is set at somewhere in the low threes. Well, mortgage rates at the moment in the US are in the mid-sixes, right? So no one is going to switch homes to suddenly double the cost of their mortgage, and that's what we're seeing, very, very low housing turnover, and that affects companies that obviously operate in that space. But we think we're pretty close to the low in that environment at the moment. Then the companies themselves that have faced individually specific issues, both Reliance and Reece with tariffs, and then Reece with the former business owner of one of the businesses they bought, starting a competitor and nabbing 25% of their staff at the end of 2024. But again, we think we're working through those issues, and we always think that one of the best indicators for true value is when you see a major shareholder, and preferably the person running the company or at least sitting on the board, absolutely back up the truck, right? We saw it with Eagers buyback in the 10s a couple of years ago. We're seeing it at the moment. Reece obviously just completed a $350 million buyback. Now, when they control 2/3 of the company, that's effectively them spending 2/3 of that $350 million to buy stock because they certainly didn't participate, right? That's a pretty good indication that on a through-the-cycle basis, they're seeing a lot of value here.
Yeah.
And as we've said internally many times, there might be lots of reasons why people sell stock as an insider. There's only typically one reason they buy.
Yeah.
And, launching a large buyback where you're not going to participate, where you control 2/3 of the register, is a pretty good indication that, or pretty close to insider buying.
Yeah. So those were companies in some of the unloved sectors, retail, REITs, healthcare, and construction. Are there any companies in the portfolio that you can talk about that maybe in hot sectors where people are starting to worry about valuation, but you see quality as so high that you're comfortable with the valuations?
I was hoping that question would take a different turn because I'm very happy to talk about.
Oh, if you want to shit on some companies,
with absurd valuations.
We'll ask that next.
Listen, I think the retail valuations are starting to concern us, so we have taken our positioning down a little bit there, and we think they're some of the best companies in the market, and I've already listed a number of those: Nick Scali, Eagers Automotive, ARB, Breville. The valuations for all of those businesses look a little extended to us, so we've been trimming those positions. The one area of the market that's been really hot that makes no sense to us is in the financial space. We actually think, this may be a big call, but I actually think that at least 3 of the 4 banks have completely lost their competitive advantage. And if I just explain that for a second. So a bank is a pretty simple proposition. They need people to give them deposits so that they can then lend that money to borrowers, right? And so your 2 groups of customers are the people that give you deposits and then the people that borrow from you, right? And the banks have done a pretty good job at irritating both groups of customers for a long time. And so it hasn't taken much for a serious competitor to come along in Macquarie and disrupt that equation. And because of what the banks have done, they're allowing that disruption to happen really easily, and we think it may well accelerate. On the deposit side, the way banks have treated their customers for years is, to me, absurd. So when you get 50 basis points in your savings account, right, when the cash rate's near 4, they are effectively charging you 3.5% as a management fee annually for them to hold your money, right? I mean, the funds management industry gets criticised for fees all the time, and yet you look at that situation and you think it's absolutely ridiculous. And so all it took was Macquarie to come along and say, well, actually, why don't we give you something that's pretty close to the cash rate? And all of a sudden they are attracting an enormous flow of deposits because you can get 3.9% at call up to a couple of $1 million, and then it doesn't drop that much actually, even if you are in the uber wealthy camp that has more cash sitting on the sidelines than that. And so then you think about the other side of the equation. What about the borrower side? Well, the great thing about NAB, ANZ and Westpac is they've completely cut their tie with the end customer in the majority of cases. So more than 70% of loans that they write today in the mortgage market go through a mortgage broker. So they don't have a relationship with the end customer anymore. They have a relationship with a mortgage broker. That is an absolute disaster for the banks that hasn't really come to fruition until I think now, right? Because all it means is that the mortgage broker is the customer. They only care about 2 things. They care about the lowest rate that you can offer to their client, and they care about turnaround times.
Yeah.
So if you can compete on those 2 things, you can take share away from the majors very, very easily. And we're not talking about them relying on this channel for 5% or 10%. It's north of 70% of the mortgages they write, right? For those 3 banks, CBA is actually the inverse, more than 70% come from their direct advisors. So they have effectively outsourced that relationship, which means that Macquarie can come along and steal that relationship very, very easily, right? And they're able to do that because they have a natural cost advantage, right? So if you think about Macquarie, what's their cost advantage? They've got the best tech stack, right? Somewhat unbelievably, Westpac's just about to start an integration of, I think, 18 or 19 systems that go back to St George days, which is somewhat remarkable, right? Well, Macquarie don't have that. They don't have a legacy tech stack. And then really importantly, they don't have branches. Try depositing cash with Macquarie. You can't.
Yeah.
It's very, very difficult, right? It's electronic only. But these days, that's what a lot of people care about. They want to transfer funds electronically, right? And so that's meant that they've actually got a superior proposition in terms of the return on equity that they can deliver, right? Making the same loan at the same price as their peers, right? And just to put this in context, they've gone from 3% to 4% to 5% to 6.2% over recent years of the mortgage market. In July this year, July 2025, they were responsible for 39% of the growth in loans in the mortgage market.
Wow.
Right? So we had thought even prior to that data coming out that on the basis of the track record over the last couple of years, they would probably go past ANZ and NAB in market share in the next decade. Well, if they continue with this sort of acceleration, it's going to happen a lot more quickly than that. So we actually think 3 of the 4 banks have completely lost their competitive advantage. The only advantage they have left is incumbency or people's unwillingness to move. But when you see the value proposition both on the deposit side and the lender side, we think that inertia will start to change, or they'll have to respond, in which case that lowers their own margins over time. So for a part of the market that makes up a quarter of the ASX 200, it's reasonably extraordinary. We think that this isn't getting more airtime.
But you're sort of bullish Macquarie.
Well, Macquarie are the other side of that equation, which we are comfortable with the returns that they think that they are generating in the mortgage market. We hear that they are very strong given their lower cost structure, which is why they are competing aggressively. And we can't see any reason at the moment why that shouldn't continue, if not accelerate.
Well, Tim, I've loved this conversation. I think I could probably do another hour if we had the time. But I think to close out today, for advisors listening, if they're thinking about talking to their clients about 2026 coming down the pike pretty quickly, the year ahead, what they should be watching for, both with risks and opportunities, what's some lessons or some counsel you would leave the advisors listening today?
The last thing I want to do is give counsel to the advisor group. I'm not an advisor. But I guess in terms of how we think about things, make sure that you know what you own, right? Know what you own. In the case of a lot of the private credit instruments at the moment, the more layers that you find between borrower, right, and the person providing the money, the more risks there are and the more conflicts, agency conflicts there are in that chain. And that's what we've already started to see with some of the issues in that space. So you really want to know what you own. That's pretty clear in the listed space. I think trying to dig in to the extent that you do own private assets to what the funds or the companies are actually doing in the private space is probably worth its weight in gold.
Nice. Well, Tim, it's always a pleasure listening to you talk about markets, and today has been no different. So thank you so much for sharing your time with us, and hopefully we can get you on again.
Thanks for having me.
Thanks, Tim.